Hi, this is Pat Moorhead with Moor Insights and Strategy, and we're here for another 6-5 podcast, episode 166. I cannot believe that. If I sound a little bit gruff this morning, it's because I rolled in around 1 a.m. last night. Dan, what are you up to? You on the road? I hear some activity
you know
going
what?
on.
It's additive and punitive. Like you're like, I'm on the West Coast and I'm gonna get home super late. And then, Dan, can we please wake up extra early so I can help you on the East Coast to get your pod in before I start my day? Yeah, look, I really appreciate you toughing it out. I noticed you made it all the way from your bedroom to the other bedroom in your house. You've been up and at it for a while, but
Yeah.
no, it is good. This is the best part of the week, and even though sometimes when we do have travel challenges, and you and we always make concessions for one another, and I think that's
Yeah.
what makes this show great. Is what we don't do in most cases is let this show, get pushed or not happen, and that's really easy to do with the pod. And by the way, that's why we're on episode 166 is because we freaking show up and do it.
I know. Gosh, dare I say we're friends? I think we're
Uh,
friends, Dan, and we kind of help each other out. But yeah,
I
everybody
like
needs a
you.
friend to help them out,
I like
and
you, but don't tell
sometimes
anyone.
step on their head.
Don't
Don't
tell
tell
anyone.
anybody, right?
You know what I
Yeah.
mean? Let's
Well, hey,
not go public with that. Hey, by the way, did I see that? Did we add some talent to the 6-5? Did I see some news drop yesterday? Did something happen
we
this week?
we did.
Oh my god!
We welcomed Diana Blast from her production company. Diana, I've known her for 15 years. Not only print journalist, but also a video journalist, and we're really excited to have her on the show. Um, we're going to have her new show called Connected on the 6-5, and also she is going to be a host at 6-5 on the road, 6-5 in the booth, 6-5 custom production. So we are super excited to have her on the
As
show.
I like to say, here we grow,
I
baby.
know. Look at that. I love that. We have a good
Sorry,
show for
I
you
had to plug
today.
that.
No, I appreciate that. I was going to plug it at the end, but
We can plug it
let's
again.
just put that sucker up front. We have a good show for you today. It is absolutely an Earningspalooza. We're going to be talking Microsoft, Google, Amazon, Intel, T-Mobile earnings, and then we're going to bolt on Microsoft Activision at the end. Just want to remind everybody we are talking publicly traded companies. Don't take anything what we say as investment advice. If you looked at my portfolio, you certainly wouldn't do what I
Come
indicated.
on, be
out
nice.
there.
Be nice to yourself.
Well, I mean, come on, I got to be a little self-effacing.
Everybody that was growth, not everybody, most people took a little bit of a bath over the last 18 months.
Yeah.
It's that you have to just keep doubling and tripling down. That's actually, I'm kidding. I'm not giving any strategic advice. I'm just joking.
No, I love that. So, hey, let's dive in and talk about some earnings.
Yeah.
So I think the mood on the street was very cautious, as I think it should have been. Is there a difference between consumer? Is there a difference between commercial tech? Is there a difference between durables versus services? It's kind of a very odd thing. So everybody was waiting to see what Microsoft would do with bated breath, and I think they cranked out a very solid fiscal year 23 Q3. I mean, they didn't blow away, but they exceeded revenue and EPS, and the market responded very well. Everybody wanted to know, hey, what was going to happen with cloud and Azure? And cloud had some very big, respectable numbers at about 25%. And Dan, isn't it wild how these cloud numbers are kind of congealing around, in the 20s? Azure was down versus prior quarters, but again, not a huge deal. One of the things that I noticed in overall theme, particularly when I looked at the call, was overall growth was down, right? I mean, overall, you're looking at 7%. Being down in Windows on the consumer side didn't help. But what they did do on the call is they did talk 10 times. I counted them myself, talking about where Azure took share, analytics took share, biz apps took share, Collaboration teams took share. Security took share across all major categories. Hiring business, i.e. LinkedIn, took share. Daily installs of the Bing mobile app, share gains. Edge took share, 8th consecutive quarter, the browser. Bing gained share in the United States. Share gains in Azure, Dynamics, Teams, Security, Edge, Bing. And that was discussed not only by Satya, but also by Amy Hood. So, company is very well diversified between consumer and commercial. They're definitely tilted toward the commercial side. What everybody really cares about is, in the end, was cloud, and a lot of questions about AI and how that was rolling. Not a lot of details on that in terms of numbers, but really making the case for future goodness with AI.
Yeah, it's interesting. If Satya takes a page out of the Jensen Huang playbook at NVIDIA, just says AI like 100 times on every earnings call, the stock should start seeing like, one bit per mention. You get a percent gain for every 100 times you say it. But this was a quarter that was really all about the company's investment in OpenAI. So you kind of hit on a lot of the numbers. Look, I mean, the fall off from Surface was to be expected. They were right in the thick of everyone else, around 30% down, and had they done any better than that, it would have been a complete surprise. Look at Apple, almost 50% down. So, that was the hardest part. The deceleration of the cloud growth is interesting, but again, this is a compounding number thing as well. Yeah. Law of large numbers is you can actually be growing more revenue, but at a smaller percent. That's what happens when you get bigger. And, for a lot of companies, it's like at some point, and we'll talk about this when we get to AWS. It's like, yeah, you're growing slower, but you're still growing by billions of dollars in revenue annually. So Azure's there, and Azure obviously, seems to be growing right alongside, what we saw with the numbers for Google. It just seems that some of the deceleration is more about that large number thing, and some of it is about the fact that we have a little bit of cautiousness among CFOs, among operators are kind of hanging on longer to some of their infrastructure, moving workloads more cautiously. But I think for Microsoft, if I can really summate it, this was a quarter about OpenAI. This was a quarter about going all in, making a $10 billion investment and layering their capabilities into every part of the Microsoft portfolio. And so when you saw the bullishness that came out of a good quarter here, I think the bullishness is that people see that they've made the right investments into the right areas, and making those investments into the right areas is going to pay off, because the company is going to win share. They're going to win a piece of search share. Although I do think Google is going to have a good response, and we can, we'll keep talking about that one. They're going to win additional value from their portfolio as companies look to streamline investments in human capital and use technology more efficiently. That's going to be, very evident in the productivity suite. And then you're going to have, teams will continue to grow. Although there was an interesting debundling this quarter, and then that's going to be that was announced, and that's going to happen. And then I think the final, piece of it is going to be Dynamics. I mean, their CRM product is growing really impressively. I think they had mid double digits, 27% growth of the CRM in the cloud. And so they had a lot of good results across the board. We won't touch on the CMA here, because the CMA, the authority in the UK, did block the Activision deal, but we're going to come back and talk about regulation here later in the show. So that's it. That's my take.
No, it's a good take, Daniel. And let's move on to another earnings, and that's Amazon and AWS. We like to separate them because the businesses are just so different.
Well, I think the way it kind of works is Amazon ships massive amounts of revenue, then AWS makes all the profit. I think that's pretty much how this business has been designed, and that's always been part of the reason that it will probably be a challenge for the business to ever get split up. When they've been conversations about the possibilities of that happening, is there's so much interdependence between the two. But let's the first response is better than expected. Look, Amazon had a couple of really tough quarters, and a lot of it's had to do with this. They made a massive investment in Rivian a few years back, and the Rivian stock is down like 90%, and they've had to take these huge mark-to-market write-downs of the value of that stock. And while Amazon obviously did make some big investments, not only in Rivian, but also in electrification, and I think that was part of the whole narrative, that's an interesting issue for a company to run into, is when a big public company makes an investment in another public company, and then they have to actually, suffer through the other company's performance on their own earnings report. It's not a real common thing to have happen with it. It's such a large magnitude that's taking you from significant earnings to significant losses. I think a lot of the street thought revenues were going to be soft, and this has a lot more to do with that kind of macro environment. People thought that consumer was down, this looming recession that everybody keeps talking about. I still think it's out there, Pat. Between you and me, there's still just a lot of reasons, between the high interest rates, this kind of rocky banking situation. There's a lot of cautiousness across the board. But having said that, some of the numbers that came in this quarter just don't reflect that. It seems like maybe it's the habits of the pandemic. Maybe it's the fact that Amazon is getting more wallet share, and people are just using their services. I feel like, I don't know about you, but I feel like I order something from Amazon every day. I literally can't think of the last day something hasn't been dropped on my porch from Amazon. So, that's a good thing for the company. After they announced, they had a really strong response. Everybody was really excited. Now, when their CFO came on and talked, they did mention a little bit of cautiousness about the AWS growth, and I'll let you dig into that more momentarily. But that kind of killed the buzz. It totally killed the buzz, because of what we talked about in the beginning. It's so important to the company's profitability. On a more positive note, one of the things you and I have talked about over the last few quarters is Amazon as an advertiser hasn't been discussed a lot. But this quarter, Amazon did almost $10 billion in advertising. And that was above the expectation there, which has been something that we've been watching, because advertising is both a diversification and another significant profit center. And as Amazon becomes more of its own ecosystem, the advertising becomes a real growth opportunity for the company. You look at some of the developments. They announced Bedrock this quarter, which is going to be Amazon's large language model. That's going to be their Chat GPT. And, one of the things, if you look at something like how will AI now affect the searchability and product, well, Amazon has this really interesting connected ecosystem between its devices, ambient technology, and between the commerce. Pretty soon in the home, I can see, because they've been doing the conversational AI thing for a while. I mean, they've had all these devices, all these echoes and systems to be training for a long time. So their play in AI is going to be really interesting. And the tie-in between AI advertising and the smart home, or the intelligent connected home, is going to play an interesting role for its long-term growth, as it's going to make shopping even easier, and it's going to make the ability for Amazon to know and predict what people need even more proactive. So you can see that as another area of the company. So, like I said, I'm gonna kick over to you to talk about AWS. But the last thing I'll say is Amazon's been pretty aggressive with cutting costs, and so part of its path to profitability has been cutting costs. And I think I pointed out in a way where I'm sensitive to companies reducing, because there's a very difficult human element to this. But as you've seen, whether it's been Meta, whether it's been Amazon, the street is looking for companies to trim the fat right now. Companies hire too much. And if you look at from 2020, before the pandemic, to now, even with the cuts they're making, they're still way bigger. Way more people are working at companies. And I think they hired too fast, too aggressively, and we're starting to see the ships getting righted. And while it's hard to say, I think that has been part of the recent run-up.
Good stuff, Dan. Thanks for leaving me a little bit of oxygen. But with a company like Amazon, there's a lot of room out there. So the AWS revenue growth number wasn't anything to swing you around the room. It was 15.7%, but I'll balance that out to it's honing in on $100 billion in revenue. That's just absolutely amazing. There was a lot of talk about customers optimizing spend. As you said, Amazon CEO Andy Jassy was really clear that this is cost optimizing versus cost cutting. And they're taking a long-term view, actually helping customers optimize their spend. And he said in the short term could be a drive declines, but this is a 10-year bet. And the way that he talked about this was reiterating what he talked about on one of his infamous CNBC interviews, that there's 90% of global IT spend is still on-prem. And
That was a great interview.
I know it really had ripples out there.
I enjoyed that.
And the other big observation that I had from the call was really leaning in on its own chips for AI. And let me read the quote here. He said, quote, "I think there's a lot of chips out there, particularly GPUs, which are optimized for this type of workload. They're expensive and they're scarce, and it's hard to find enough capacity." And then he went in and talked about Trainium. He talked about, hey, we're on our second generation of inference chips with Inferentia. And then he went through his whole generative AI play with Bedrock, and including his own Titan models. So I thought it was a good way to play that, because, how are you going to play that, right? You have maybe three options. And I think he just leaned right into that, and that is classic Amazon, which I think investors appreciate. I mean, if you remember how long the company never made any money, right? And they just kept growing and growing and growing. I think they've demonstrated that once they get to a certain place, they can make money in nearly every market that they get into. They did cut a few retail lines, which to me makes sense. It was funny. They rattled them off. I had never actually heard of any of them, like Amazon Fabric. I have no idea what that is. It's fabric store, I guess. I must not be in the demographic, but all in all, I think pretty good showing. So Daniel, let's any final words there?
No. I guess I would just say, if you really want to get a good perspective on the Amazon opportunity, I thought that CNBC exclusive and the interview with Andy, and then that whole shareholder letter really gave me some perspective, because I'd been kind of wondering if we'd hit the wall. And yeah. I think Andy, and Andy has not necessarily been the same as Jeff as a in terms of how the world sees Amazon. And I think that was a really good moment for him. So I'd say to people, that's worth checking out if you're kind of looking to the future of Amazon.
Yeah. Let's it was a good interview. Let's dive into Intel. So Intel is an interesting one to discuss. On one hand, it had its biggest loss in the company's history. On the other hand, it beat both financial analyst expectations. EPS it beat by 72%, and it beat on revenue by 5%, and it beat its own public forecasts. So it's really a tale of really glass half full or glass empty. I think your tweet captured it pretty well, that you're going to look at this through one of two lenses. If you want to get all negative on it, it's pretty easy. I tend to look at it as glass full, and the reason I do that is because the company has been in the midst of a 5-year turnaround. It's about 2 years in, 3 years left of what Pat Gelsinger committed, and different types of commitments, right? First of all, let's just get really tactical, right? There's a cost reduction commitment that was made, $3 billion of cost savings in 2023, $8 to $10 billion annually exiting 2025. So this isn't a company wantonly spending money; it's spending money for the future. As we always say, that as industry analysts, we track earnings because it is the closest source of truth we're ever going to get. The downside of saying something that's not true is it's steep, because you get sued. So when the company says that it remains on track to regain transistor and power performance leadership by 2025, I tend to give them the benefit of the doubt, because the downside of not hitting that is really, really bad. The company also reiterated they are on track to meet the goal of achieving 5 nodes in 2 years. 2 of the 5 are done. Intel 7 is high volume, and Intel 4 ramps with CCG's Meteor Lake, and they're going to launch it at the end of this the second half of this year. And Intel 3, 20A, and 18A, company says remains on track. That no way, shape, or form says that the company it lacks risk. There is risk, right? There's a lot of execution to go. One thing I wasn't pretty enthused about is that the company did say it took share in client computing, which again, you got to look for some of the bright spots here. I wasn't expecting it. I don't think anybody else was expecting it either. Overall, right, the company reiterated, right, the macro view, the future view of the big opportunity in the markets, outlined the highlights of Q1, which I already rattled off those highlights, and then talked about strategic priorities moving with IDM 2.0 to IFS. So company continues to focus on what they can control. I mean, you really can't control the market. In some ways, you can't control your competitors. All you can do is control yourself. So probably the final thing that was a surprise, I think overall to everybody, is that the networking and data center market is in pretty dire shape. I saw a financial analyst talk about 30 weeks of CPU inventory out there in this space, and that's pretty crazy. And what we won't necessarily see, if the cloud providers are much better and more efficient at using their compute, then they don't need to buy as many chips as they thought that they needed, right? So even though, I mean, actually, we have seen a slowdown in public cloud, but not even close to the rate and the deceleration that we've seen by Intel in this space. I'm really interested to see how AMD does, to check up on that market share thing, and then see how the company did in its data center lineup.
Yeah, I think you hit a lot of good points there, Pat. I mean, first of all, I'm going to be at risk of being the trend guy, but I think the future of Intel's success in a lot of ways is going to be its ability to attach to this strong adoption of artificial intelligence, proving that a lot of AI is still done on the CPU and making sure that it maintains and grows its market in that particular space. Because right now everybody's talking about GPUs and everybody's talking about accelerators, but a lot of inference, a lot of machine learning, a lot of utilization of AI within systems of record is still done on a CPU, and that's something that I don't know if Intel's getting a lot of credit for, because, like I said, right now I think the market's kind of, and they call it DCAI, and I get it, but their actual, I know they're moving towards having some very specific data center GPUs, but really right now their big AI numbers have always been built into Xeon and into the way Xeon gets deployed for AI workloads. The other thing I think that was a really big sort of moment is this was the bottoming out of the margin. Now, if you look back maybe a decade, Intel had margins in the 60s. Intel's margin this quarter was 37.5%. So you can see why the market would have some concern about that. Having said that, you and I had a chance to talk to Pat Gelsinger after earnings. And, I think we asked the right questions. We weren't, what's the optimism? And I mean, I think the optimism comes from a place of this really probably was, Pat, the final gulf in this kind of rundown that has been over several quarters, and where the company's strategy, being on track to launch their next process, the investments it's making in, 5 and 4 IDM, IFS are going to start turning a corner. The growth of AI at the edge, the return to, you mentioned the market share gains in client. are starting to be small indicators that we are going to maybe start to see this momentum turn. And again, as long and as slow as it took to turn downward, it's sometimes even longer and slower to turn back upward. But
Yeah.
company has huge percentages of customers. They have very deep and tied in roots in channels, and these channels don't change quickly either. The way distribution and goes to market is a long slog. Ask anybody who's tried to enter the PC market just how hard it is to enter this market. The demand for compute, as you said, may be down because compute is more efficient, but you look at the impact of AI and it's going to need more compute, and we know how much more compute. And like I said, it's not just going to be GPUs. It's gonna a lot of these things are parallel computing. You're gonna have GPUs, you're gonna need CPUs, you're gonna need accelerators, you're gonna need NPUs and IPUs and DPUs and all these, and obviously the disaggregation is leading to lots of different things. Now Intel's narrowed its focus. It's not in as many things as it was before. Hey Pat, one thing we didn't call out, a bright spot, the lingering investment in Mobileye is paying off very well. Apparently Mobileye is growing at quite a nice clip, 16% this quarter. So they are still the largest shareholder of Mobileye, despite the fact that they spun that off from a financial standpoint. And Pat, the last thing I'm going to say is this: is Intel's long-term prospects, in my opinion, sit pretty heavily on its ability to execute its IFS strategy. I really do think, that you're going to see multiple compute platforms, x86, but also RISC-V and ARM and others, and the CHIPS Act and that whole thing. I know we got tired of talking about it now that there's not a supply chain issue anymore, but the ability to manufacture leading edge chips here in the US on multiple platforms, who else is going to do it but Intel? So if that trend is really going to happen, it's going to happen here, and that's a big opportunity for the company long term.
Yeah, TSMC and Samsung want to do it, but I don't think. I think once Intel, I think Intel's going to be competitive, and I think the country flips to local sourcing for super important infrastructure beyond the military. Dan, let's
move into. Sorry, go ahead.
No, go ahead.
No, I was just going to say that we need to move forward, but if we actually are going to be people of our word in terms of what we did the CHIPS Act for, having Samsung and TSMC do it would be so ironic to me. Or is it hypocritical? I don't know. It'd be one of those two things, but it wouldn't. We do need to have some dependence on a company that we actually have that is domiciled in the USA. Otherwise, why did we go through this whole exercise?
Yeah, the country needs a strong Intel, and I think Western Europe needs a strong Intel as well. So U.S. and friends of U.S.
If things go really wrong, and if things go really wrong in China, Pat, so will TSMC will need a strong Intel too. So
good point. But TSMC is committed to not putting their leading edge in the United States. So there we have it. Let's move on. Good snarkasm. Let's talk about Google/Alphabet earnings. Dan, why don't you take this one?
Well, Pat, I had the chance to go and talk to Carolyn Hyde on Bloomberg about this, so I'm fully inundated on this one.
Of course you did.
Yeah, I know. I forgot what else I was going to talk about. I just needed to drop that. Anyways, Tuesday was a good day. Like I said, because the last several quarters have just felt so depressing. Yeah. It was the first wave where we had good results and everyone was selling because, we just saw the imminent glut and doom and slowdown that was going to happen. And then there was the next several quarters where things actually weren't good and then the numbers weren't good. And so, when you're doing what we do and you kind of come around and you cover this every quarter, you're like, God, I could really use a little bit of a wave of bullishness. And of course, I said this earlier, we still have lots and lots of challenging moments ahead of us, but it's good to see, what's happened over the last several quarters is you have seen a fairly significant adjustment down. And so, we haven't really talked about that here because we're just saying, hey, they beat, but everybody's beating right now on much more tempered guidance. Remember during the 21 year, it was like, we're going to grow 90% and then they grow 200%. It's like, oh, this is great. But that's not the world we're in. Over the last few quarters, we've seen, we're guiding a little bit more cautiously. I mean, Google grew 3%. Or Alphabet, 3%. So that's not a huge top line growth. But remember, this is top line growth over what was those remarkable quarters after quarters after quarter of really good top line growth in a period where everybody says the world's probably going to end. Is that good enough for doom saying that we're at the world is going to end?
That's really good.
The company beat on top, they beat on the bottom. They came in most of their categories. At YouTube, they were above. Cloud was right about at consensus, and they cut some costs. So their traffic acquisition costs and also just some of their overall operating costs were down. And again, they've made cuts too. They've been, quietly cutting staff and headcounts and slowing down hiring, which again is very, very well received among the street. People want to see operational excellence, and it means you can't spend too much too fast. Pat, this was a big quarter for cloud. And again, I'm going to save that one for you to talk more about the details, but actually showed a profit. Now, again, that was a quick turn. And there was some accounting in terms of depreciation that they changed some of the way they account for depreciation, which does help. But as I always say, when you look at non-GAAP results or what they call adjusted earnings, there's always lots of interesting things that are happening in there. So, I don't judge, because again, you'd have to judge against every company that has an adjusted number and how they get to those. People accounting is a tricky field, and there's a lot of areas and different ways to move things around. But this was huge. You were talking about losing hundreds of millions a quarter. And by the way, they've been investing in it. So, the overall business though is healthy. And Pat, here's probably what I want to talk about most, other than cloud, because I do want to leave you something to talk about, is how at risk is Google's business model with the onset of generative AI? And that's probably been one of the biggest things on my mind, is that when you have a company that had cornered a market in search, and it has definitively control of market share, meaning, high double digits into the 90% of market in advertising. And for every 1% of the search market, they figured it's around $2 billion of revenue. All of a sudden you have something like a chat GPT embedded into Bing, and you have 7.5 million people download Bing in a day or in a week or some very short period of time. And you go, oh my God, is the search market at risk? Because that's really the question mark for people who are long or people who are short Google is the search model, is this business model sustainable? And here's what I'm going to say is that Microsoft got a distinct early mover advantage by being first, by going in with OpenAI and deploying it across its product portfolio. But Pat, we need, just like we talk about with chips all the time, we need a healthy competitive ecosystem long term to make it better for everybody. So the thing is I do think Google will probably cede a little bit of search market share to what Microsoft is doing. I think Microsoft's going to be very aggressive. We talked about last week with the Samsung potentially buying access to being on the Samsung devices and mobile. But I think the kind of early concerns of Google and its search, its business model, and its the early concerns of its falling off a cliff are premature. I think the early concerns that Google will not have a answer to ChatGPT or OpenAI is early, and I think they will become very competitive. I mean, you got to remember, this company's probably spent more money over the last decade on AI than most of the rest of the tech industry combined. And, they had Google DeepMind, and they have Brain, and they now have decided to join forces, put them together. And I think what will start to happen is you'll see innovation accelerate. I mean, I give a ton of kudos to Microsoft for the move they made. They absolutely knocked Google between the eyeballs.
Yeah.
Put them off balance and forced them to come early to market with a product they really didn't want to bring to market yet with Bard. And now, Google's going to embed generative in its search. That's what's been, come out this week or last week recently. And I think once people see that it can kind of do the same thing, though, all that migration, that early migration that was happening, people are like, oh, Google does this too, I'm fine. So now Microsoft's going to have to find a new sort of thing to sort of create buzz and interest. And I mean, I think their thing is going to be the fact that it's built into so many of their tools. That's going to be an effective way to get people using search right in your productivity or right in your Office suite. But I just don't see the share moving that quickly. So overall, solid quarter, great news on the cloud, interesting inflection on the AI side. But this is going to be a fun one to watch.
Yeah, there were 4 parts to the call. First two were updates on what they talked about the previous one, which was AI, and then the focus of the company and the efficiencies. Two businesses they highlighted were cloud and finalized with YouTube. I'm going to focus on the cloud part. So, as you said, for the first time, the company made a profit in cloud. I saw the haters came out and said, "Oh, at AWS it was 10 times at that revenue level." That's fine, but still, cloud made a profit. What I really appreciated was the amount of time that Google does commit. Hey, Dan, would you mind putting yourself on mute for a sec?
Yeah.
Thanks, dude. I really appreciated how much time they spent on Google Cloud, and really some great nuggets that came out. So first of all, over the past 3 years, Google Cloud's deal volume has grown 500%. Large deals over 250 million, growing more than 300%. So the selling motion, rapid expansion since TK has come in there. And then you have to have people to implement, and partners, right? Certified practitioner partners increased 15x. Global SIs have built 13 dedicated practices on Google Cloud compared to 0. I also appreciated them talking about where generative AI is actually in use at customers today. Palm generative AI model and Vertex are at BehaveOx for security, Oxbotica to test autonomous vehicles, and a company called Lightricks to develop text-to-image features. I think that's important, right? I think the company actually did a really good job talking through this. It also talked about it has 30,000 cybersecurity companies, including big companies like Broadcom and Europe's Telepass. So, and interestingly, and in contrast to how AWS talked about GPUs, it talked a lot about NVIDIA, right? And it did a little bit of a flex that said they're the only provider to announce availability of NVIDIA's new L4 Tensor Core GPU with its G2 VMs. Thought that was super interesting. Now, it did, again, lead with TPUs, but it followed up with a very strong statement with NVIDIA. NVIDIA, by the way, must absolutely freaking love being cited in somebody's press release. So, all around, I'm really happy with the progress that Google Cloud is making. I'm less hung up about comparisons to other companies, but if you look at the size, I mean, it's slowly becoming one of the largest enterprise provider of software and services out there on the market, and I consider that a win for the company. That's very consumer heavy. Any final comments, Dan?
No, you know what? And sorry about the noise. Getting ready to do another shoot here in the background, Pat. But no, I actually was impressed. And like I said, with multi-cloud heating up, I like Google Cloud's prospects. And again, it's more about the like it's that Andy Jassy comment about the 90% is on-prem. If you believe that only 10% of workloads will ultimately be in the public cloud, which I think there will be more balance. We're seeing that, but Pat, there's so much growth opportunity here, and Google has some really nice competitive offerings. And so I think in the multi-cloud era, Google's going to do really, really well. So, it's promising. It was a good quarter.
Yeah. So let's move off of cloud and move into T-Mobile earnings. I think T-Mobile does one of the best spreads, the best productions when it comes to earnings. I mean, they are the uncarrier, so they are going to do it differently, and they're going to do it quite very differently versus Verizon and AT&T. So overall, they beat on EPS by about 16%, with a slight miss on revenue. Now, they did beat on consensus expectations on postpaid net additions, postpaid net customer additions, high-speed internet, EBITDA, and adjusted cash flow. So the company's doing great. And hey, we have a guest. How about that?
Yeah, Mr. Laco just wanted to say hi. Broadcom's head of their mainframe software division. So he's rolling in, saying hi, and interrupting your flow.
How about that? Hey, we haven't had a guest pop in since Pat G at Mobile World Congress, but it's great to see 6.5 customers out there. And Dan, it's too bad that the 6.5 isn't there right now, but we are in spirit. The 5 is there. Nice.
The 6.5 will be doing a summit recording here today with Greg. So this 6.5 summit, which, by the way, you better have signed up for. Yeah, it's going. But I'll let you keep going because I know we're both running long here.
Yeah, but no, overall, I mean, the company did great. The one thing I really would like to see from T-Mobile is hey, can you talk a little bit about T-Mobile for Business? As we've seen with Google, even though Google Cloud is, particularly in the beginning, was such a small part of their business, Google still talked about them, and particularly over the last year. So I would love to know how T-Mobile for Business is doing. And right now, based on the earnings, we have no idea. I know I like the T-Mobile for Business strategy. I like many of the services that they brought out, but I don't think it elicits confidence to just not talk about it. Now, I totally understand that the size might be small, but I feel like earnings have really turned into a lot more than just big time company analysts. I mean, you have retail investors, you have industry analysts tracking what they did, but quite frankly, they've been doing great. They've been trucking the competition. In fact, Mike Sievert came right out and said, called out AT&T for a statement that it made on its earnings call about having the lowest postpaid phone churn in the industry, yet their customers reporting that they're 50% more likely to switch than Verizon or T-Mobile. Uwe Valtsen, right, the new CTO, also veteran of the 6.5 summit twice, made a little bit of a cameo appearance that I thought was nice. Another thing that they pointed out that, hey, we're T-Mobile, we're making all of this progress, but we're spending 60% less in advertising than Verizon. I love, the competitive flex here, kind of turning up the contrast ratio. There was one paragraph that I'm going to read verbatim about T-Mobile for Business that Mike said. He was talking about churn and net adds. He said, a perfect example of this, T-Mobile for Business, where we just posted one of our highest ever phone net add quarter in Q1 with the lowest business phone churn in our history. We are profitably taking share with more business account net adds and more business phone net adds than Verizon in the quarter. I love the, Dan, we were talking a little bit about competition related to Google search and Bing. I mean, T-Mobile is the absolute poster child for what happens when you have a lot of really good competition out there and it can just churn it, because they are giving T-Mobile, they're giving Verizon and AT&T absolute headaches.
Yeah, you covered this one really, really well, Pat. So I'll just add that, I think T-Mobile continues to be the disruptor. And what I like about them most is, even now that they're now the leader, they continue to play disruptor. And I think that's really kind of a DNA thing. And it started with John Legere. It's transferred to Mr. Sievert in his leadership role. And I think that's why the company continues to compete. Some of the growth in things like high-speed internet and beyond just phone handsets has been really good. And I think one of the things that people really, if they are tracking the company, paying attention, is that business opportunity. The T-Mobile for Business, you got lots of impact with 5G as it turns from this consumer handset thing to a business productivity, connectivity, and security tool. T-Mobile is very well positioned, has a lot of spectrum, has done a good job of building a platform, and now there's a lot of upside for growth. So I'll leave that one there. Keep us moving and get us. I think, are we done? No, we're not done. Are we? We're not done.
Come on, man. Got one more here. No, let's go to our final
topic. About this one, or just you?
No, you can talk about this one. You can kick it off. We'll both talk about it. The Activision deal was blocked by the UK CMA. Dan, why don't you take this one?
Well, I mean, look, where innovation goes to die. See where innovation goes to be taxed is the European, competition with Miss Vestergaard, and where innovation and M&A goes to die now seems to be the UK. First it was which one was it? NVIDIA got blocked there with ARM. VMware is now, getting tied up with Broadcom in the UK, that CMA. And now the CMA is saying that cloud gaming could be dominated by Microsoft if they were to acquire Activision because of a couple of very I think it's Call of Duty. Is that the big one?
Exactly.
I'm not a gamer. I'm going to admit this. It's going to be embarrassing, but I'm not a gamer. But I mean, look, this is one I just want to talk about is, Pat, I don't get it. I don't get it. Who else is in gaming? Okay, I mean, I'm just thinking about this. You got Sony, you've got Google has a gaming offering, you've got NVIDIA, GeForce has a streaming gaming offering. I mean, I just you name off those three, and you're like, that's at least three massive companies with tons of financial capability to offer gaming. And then you have a whole market of mobile gaming, which has very little to do with this. And one of the things, how in the world do you really think this is going to truly block and create a lack of competition in the particular space? Plus, I believe that Microsoft already had come out and made a ton of concessions. It was already starting to, in part of the process, make their games available on more devices and make it more accessible. They were trying to get out in front of this one. To me, it almost feels like right now this is a little bit of a relevance play, like the UK's relevance after Brexit. What is our role in innovation? And to basically come out and say, we're going to block every deal that comes across our desk. Now, granted, looking back in arrears, Pat, I could have made a case for NVIDIA and ARM to be together. Based on the chips situation, you probably could argue that it probably maybe for the best that ARM goes at it alone to make sure that there is, especially if you see the movement of AI. So maybe they got that right. But here's the other problem I have, Pat, is how much are we regulating what might happen versus how much are we regulating what has happened? Because as far as I know, the mandate of our regulators when it comes to these things is not to predict what might happen in the future, what's possible to happen. Because you could say in any case, every deal could be blocked for that reason about what might happen in the future.
Yeah.
You have to look at current situation, market share, competition, consumer harm. And like I said, I never understand this, but it's always to me is so Apple can have an app store where they can charge the most significant tax in the planet and make nothing available to anybody without paying that toll. But in a market where there's at least 4 or 5 major competitors that have the opportunity to compete, they're going to say that this deal. So I don't know if I'm as angry or frustrated about the UK blocking this deal as I'm with them blocking all deals. And we talked a lot. You and I have talked ad nauseum about the Broadcom deal with VMware. But Pat, with open source, public clouds, hybrid offerings, besides the fact that customers might have to make a decision to switch if they don't like the new owner, if they don't like the offering, there's 1,000 freaking options to go open source with virtualization and hybrid cloud, multi-cloud offerings. So, I know where I'm kind of pivoting around the gaming thing, Pat, but that's what it is to me is I can't understand, what are we regulating here? Are we regulating what might happen in the future? To me, that's the wrong thing. And again, competition committees, here we are focused on the wrong things. I hope it's for more than relevance, but I really don't see what blocking this deal does to help the consumer or to increase competition in this particular market space.
Yeah, I mean, I'm concerned overall with the state. I know they're different between antitrust and IP protection. These are two fundamental things that keep the wheel of innovation going, and theoretically were put in there to protect consumers from harm. So, but a couple trends that disturb me a lot, the shifting from actual consumer harm to theoretical consumer harm. We saw this with Qualcomm. We're seeing this with VMware, and we're seeing this with Adobe Figma, right? Big is bad regardless of any other variable. We're seeing this in the UK, EU, US, and certainly China. And, if you're big, you're bad. I mean, heck, they're trying to unwind. The FTC wants to unwind the Instagram acquisition from Facebook, and that's just laughable. Again, when you have companies that are wantonly anti-competitive, like Apple, and nothing is happening to them. So the other thing that's a challenge is the regulators with zero business experience, and I'm seeing this in the US and the UK. And what this does is leads to misjudgments on what's really important and what's not. A great example of this is with Broadcom, where there's this notion that there's going to be foreclosure on a $500 NIC when Broadcom can make $10,000 on a VMware license. That's dumb. That basically means you don't really understand business and you don't really understand tech. I think the other one is Adobe Figma, where Adobe and Figma are in different, completely different markets, and people just don't understand that. They can't see or understand the separation between the two markets and what the two companies are offering, and that just causes a tremendous amount of churn and wasted tax dollars. And Adobe is all about creativity, and Figma is all about ideation. Very, very different. You talked about countries using this as a tax, and we saw this with Qualcomm, big time. EU, China, and Korea. They want their pound of flesh, and if they can't get it through real taxes, they're going to get it through penalties and fines. So I'm concerned, and none of this is good for innovation. None of this is good for lowering costs and venture investments. I'll leave you one final thing. Why would venture capitalists fund companies that could have a nearly impossible time of getting acquired at the rate that they currently are doing today? Well, they're not. And just like IP creators aren't going to be paying or investing in IP if they can't protect that IP. So antitrust, IP, we're in a very sad state of affairs. I'm going to be writing a lot more about the antitrust stuff in the future. So Daniel, looks like you are off to be doing your videos here. It's great to see you, and I want to thank everybody for tuning in.
Yeah, buddy. And hey, if I can just say, great call on and tying in Figma. Another just crazy, dumb set of. God, I'm so cynical right now. I'm gonna get quiet before I get start to get riled up. I got some stuff to do today. I got to smile.
Good. Well, I wanted to thank everybody for tuning in at the 6.5. Don't forget to sign up for the 6.5 Summit, June 6th to June 8th. We've got world-class speakers, the most important tech companies, talking about the most relevant topics out there that I know you're going to want to hear about. So thanks for tuning in. Hit that subscribe button if you want to continue talking and hearing the amazing things that we're talking about. Put all complaints to @Daniel Newman UV, and all pats on the back to @Patrick Moorhead. We care about you. We thank you. Have a good morning, afternoon, evening, wherever you are on the planet. Take care.